Hello everyone and welcome back to the Cash Flow Desk. If you've ever stared at a profit and loss statement and felt like you were reading hieroglyphics, you're not alone. The P&L is arguably the most important financial document your business produces, yet most business owners treat it like that pile of mail you keep meaning to sort through. Here's the thing though, once you know what you're looking at, a P&L tells the story of your business better than any PowerPoint deck ever could. Today, we're going to decode this financial mystery so you can actually use your P&L to make smarter decisions instead of just filing it away. Let's start with the basics. A profit and loss statement, also called an income statement, is essentially a financial report card that shows whether your business made or lost money over a specific period. Think of it as a financial movie rather than a snapshot. While your balance sheet shows you what you own and owe at a single point in time, your P&L shows the action, the revenue coming in, the expenses going out, and what's left over. Most businesses run P&Ls monthly, quarterly, and annually. The monthly ones are your pulse check. They help you spot trends and problems early. The annual P&L is your big picture view, showing how all those monthly stories add up to your year's performance. The structure is beautifully simple. Revenue minus expenses equals profit or loss. But as with most things in business, the devil's in the details. At the top of every P&L, you'll find revenue, sometimes called sales or income. This should be straightforward, but there's a crucial distinction to understand. You want to look at net revenue, not gross revenue. Gross revenue is every dollar that came through your door. Net revenue is what you actually kept after returns, discounts, and allowances. For example, a retail business might show gross revenue of $100,000, but after returns and promotional discounts, their net revenue is $85,000. That $15,000 difference matters when you're calculating your real profitability. Some businesses break this down further, showing different revenue streams separately. A software company might list subscription revenue, professional services revenue, and one-time license fees as separate line items. This breakdown helps you see which parts of your business are growing and which might need attention. Below revenue, you'll hit the cost section, and this is where things get interesting. Most P&Ls break costs into two main buckets: cost of goods sold, or COGS, and operating expenses. COGS represents the direct costs of producing whatever you sell. For a restaurant, that's food and beverage costs. For a manufacturer, it's raw materials and direct labor. For a service business, it might be subcontractor costs or direct labor hours. Here's why this distinction matters. COGS should move in direct proportion to your sales. If your sales double, your COGS should roughly double too. If they don't, you've either found some magical efficiency or there's a problem with how you're categorizing expenses. The relationship between revenue and COGS gives you your gross profit margin, which is one of the most telling metrics about your business model. Operating expenses, on the other hand, are the costs of running your business regardless of sales volume. Rent, salaries, insurance, marketing, these are your fixed and semi-fixed costs that keep the lights on whether you sell 1 unit or 1,000. Let's pause here because gross profit margin deserves its own moment. This number, your gross profit divided by revenue, tells you how much money you have left to cover all your other expenses after paying for the direct costs of what you sell. A healthy gross profit margin varies wildly by industry, but generally, you want to see consistency and preferably improvement over time. Consider how one consulting firm discovered their gross margin was declining month over month. By digging into the numbers, they realized they were spending more on subcontractors but weren't raising their client rates proportionally. That P&L analysis led to a pricing strategy overhaul that improved their margins by 12% within 6 months. The P&L didn't just show them the problem, it quantified exactly how much it was costing them. Moving down the P&L, you'll encounter your operating expenses, and this is where many business owners get overwhelmed by the sheer number of line items. The key is to look for patterns and outliers. Are any categories growing faster than your revenue? Are there expenses that seem disconnected from your business growth? Many P&Ls will show you EBITDA, earnings before interest, taxes, depreciation, and amortization. This metric strips out some of the accounting complexity to show your core operational profitability. It's particularly useful for comparing your performance to other businesses or tracking your own progress over time, since it removes some of the noise created by different financing structures and accounting methods. But here's a word of caution. EBITDA can be misleading if you're not careful. Yes, it shows operational performance, but those interest payments and tax obligations are very real cash outflows that affect your business every day. Finally, you reach the bottom line, your net income or net loss. This is your profit after all expenses, including interest and taxes. But don't make the mistake of thinking this number tells the whole story. A profitable P&L doesn't necessarily mean you have cash in the bank, and a loss doesn't always mean you're in trouble. Timing differences between when you record revenue and when you collect cash can create significant gaps between profit and cash flow. A growing business might show strong profits but struggle with cash flow because they're investing in inventory or waiting for customer payments. This is where expense management software like Ramp and Concur becomes really helpful. They help you bridge the gap between your P&L performance and your actual cash position. The real power of a P&L isn't in the numbers themselves, it's in the questions those numbers help you ask. Is your gross margin trending up or down, and why? Which expense categories are growing fastest? How does this month compare to the same month last year? Smart business owners don't just read their P&L, they use it as a diagnostic tool. They look for trends, compare actual performance to budgets, and identify areas for improvement. The most successful businesses treat their monthly P&L review like a vital health checkup, not something to dread, but a valuable opportunity to understand what's working and what needs attention. Remember, your P&L is telling you a story about your business. The question is, are you listening? With these fundamentals in hand, you're ready to turn those rows of numbers into actionable insights that can drive real business improvements. If this helped, hit that like button and subscribe. Thanks for watching, and we'll see you at the next Cashflow Desk.